Well, good morning, everyone. This is Jeff Barnes over at EquiTrust. I'm the National Account Senior Manager, and I work very closely with Partners Advantage. Very happy to have the opportunity to be on this call this morning. And what I wanted to do is share a few of the things that are working for us over here at EquiTrust. For those of you that don't know us, we are based out of West Des Moines, Iowa. We're on Westtown Parkway, although the majority of the company is still working from home. And we're known for our annuities. We do a lot of fixed and indexed. We don't just do a bunch of index sales. We do quite a bit of fixed business as well. And then we also do quite a bit of single premium life product, a lot of sales in that arena as well. So like I said, I wanted to kind of share with you some of the things that have been working over here for us. And before I do that, I did just want to touch on a couple of things. So with everything that's been going on over the last few months, we did change our policy on face-to-face sales. I mean, we just had to make those adjustments. So we do allow sales to take place that are not face-to-face. So maybe they're done through video messaging or through the phone, through the mail, those kind of things. We did open that up a couple of months ago. And I'll reference bullet point number 3, where we've added a form for that. So you would fill that out along with the normal paperwork. So just wanted to share that because that is a recent change for us. The other thing that I wanted to go over before I go into a few of the products and the sales ideas. Back on April the 1st, we introduced 2 volatility-controlled indices to our annuity portfolio. And these are also 2 vol-controlled indices that we have already had on our single premium life products. So we've been very excited. This has been a big boost for us to be able to offer these 2 indices. So the one on the left, that's the Barclays Focus 50, and that was created especially for EquiTrust. I know everybody's going to recognize the Barclays name. They have done a phenomenal job of building some great indices in the fixed indexed annuity industry. They've made quite a name for themselves. And they've been building indices like this for decades, probably used more on the institutional side, but they certainly have made a great splash in our industry over the last few years. So it's just a very clean, simple indice. It's basically made up of 50 U.S. stocks that have a focus on volatility control, along with income, treasuries. And so a very clean, very simple design, very transparent. They've got a lot of great material out there, including a website with some phenomenal pieces out there for you to look at. The other one is the S&P Mark V Excess Return Index, and you're probably going to recognize that one because it has been out there in the industry for some time, and it's been a very successful vol control indice as well. So we like to show a couple of things when we talk about these 2 indices. So we went back, this graph goes back to March the 10th. It does go through June the 15th. And we're just simply comparing the S&P 500, which is the gray line, along with that Barclays Focus 50, that's the light green line, and then the S&P Mark V Excess Return, which is the dark line. And you don't need me to tell you, it's been pretty crazy out there. in the markets over the last few months. And you can see this is a great visual showing that these two indices are doing exactly what they're designed to do, to be calm, during the storm. We also like to show this chart. So this is going back to 2004, looking at the S&P 500 alongside the Barclays Focus 50 and the S&P Mark 5 excess return. Now the Barclays and the Mark 5, they are newer indices, so there is some back testing going on there, but it does show a pretty good picture of how those two would have stacked up with the actual S&P 500. And the thing that kind of stands out to me on this chart is looking at just through the first year, or through the current year, again, June 15th, just kind of comparing those and seeing how they look so far. So S&P is down nearly 6%. The Barclays Focus 50 is just a little, above water. It's in the positive, and then that Mark 5 from S&P is around 4%. So again, I think that's a chart that tells a great story and is very visual. So when we added these indices to our fixed indexed annuities, what we did, we took the approach of adding the Barclays onto all four of our indexed products, all four of our indexed annuities. And then we added the Mark 5 to our two growth products, the Market Value and Market 7. So just to kind of show you a little more in detail. So on the Barclays Focus 50, one of the options is a 1-year point-to-point participation. And you can see on each of the four products, the Power, the 10, the Value, and the 7, you can see where we're at with those point-to-point par rates. There's no spread, there's no cap, these are just straight participation designs. And then you can see, when we illustrate our indexed annuities, we have to follow the NAIC guidelines on how to do that. And so we show, like other carriers, we're showing the best 10, the worst 10, and the last 10. So you can see where those are illustrating at today on that 1-year point-to-point par on the Barclays Focus 50. We also added a 2-year option. So again, point-to-point par, no spread, no cap, and available on all four of those products. And of course, because it's a 2-year crediting method, we're able to afford to put higher par rates on there. So you can see where those are at, as well as the best 10, worst 10, and last 10. And then I wanted to show you that S&P Mark 5. So that one, the only option is the 1-year point-to-point par. Again, no spread, no cap. And that is available only on the two growth products, the Market Value and the Market 7. The thing that I was excited to get these on our products, but I really was excited to see what we were able to do with our two bonus products, that Market Power and Market 10. One of the downsides to bonus products is you're probably not going to have as much growth opportunity, because when you have a bonus on a product, from a pricing standpoint, that can water down the rates that you're able to offer. So we're really happy, especially to get something on the bonus products where there's a little more growth opportunity. So back in early 2019, we stepped back and we looked at our annuity portfolio. And we're always asking ourselves, how can we be simple? How can we make things easier for people out there? You guys are inundated with so many companies, so many products, so many crediting methods. It's a lot to keep track of. So in early 2019, we took our portfolio from 10 fixed indexed annuities to 4. We went from 10 to 4, and you can see them all right there in front of you. We didn't just get rid of 6 products. We took the best of what we had. We made some great enhancements. We refiled, which opened up a lot of state availability for us. And we settled on these 4 products. The 2 on the left are the bonus ones, the Market Power and the Market 10. And then the 2 on the right are the growth products that are built for accumulation. No bonus, but much better or higher crediting methods. So I want to focus in first on the Market Power. This has been a cornerstone indexed annuity for EquiTrust. In fact, we have had this product since 2004. It's one of the oldest FIAs that is still out there being sold today. Now, don't get me wrong, I'm all about innovation. I love to see new products come out. But when you've done something right the first time, it makes sense to stick with it. So I like the fact that we have a product that has been around for that long. And I say that because EquiTrust is one of the few carriers that publishes all of our renewal rates out on our website. We don't pick and choose which products we show. We don't pick and choose which time frames we show. You can see exactly how we've treated our clients since the day the product was launched. So we've got a product that's been around since 2004. It's got a lot of legs underneath it. And when I talk to our actuaries and our product development folks, they always remind me, they say, Jeff, make sure you're telling folks that when it comes to renewal rates, we raise them when we can, we lower them when we have to, but we don't subsidize. We don't do this come on rate knowing we're going to kick them in the shin down the road. And we feel comfortable about the integrity and the transparency of our renewal rates because we publish them. So the Market Power, in most states it's a 14-year contract, but there are now, or I guess actually effective July 1st, there are 16 states where instead of it being a 14-year contract, it's a 10-year, but it's still a 10% bonus throughout. And I'd mentioned when we redid our portfolio, we refiled and opened up a lot more state availabilities. So with the Market Power, it's not approved in California, unfortunately. It's not approved in Delaware, unfortunately. It's not in New York because we don't do any business in New York. But those are the only states where this 10% premium bonus product is available or is not available. So that opened up a lot of states for us. I know there are people in Texas going, there's no way you have a 10% bonus for me in Texas. Well, we do. Minnesota, Utah, Nevada, Connecticut, PA, Ohio, states where you really don't find a lot of big bonus products, we've got them in there. So we were very pleased to be able to do that. I want to show you where we are at with the current rates on the Market Power. And we do something a little differently. We have 2 sets of rates for each product. We have higher rates if the client does not elect the optional income rider. And then we've got lower rates if they do elect the income rider. Income rider, from a pricing standpoint, can weigh the product down. And we felt like, why should a client who doesn't need an income rider be penalized? So we're able to offer higher rates without the income rider being added. So I'm just going to focus on those rates here, but you can see very attractive. Again, we're talking about a 10% upfront, no vesting schedule. We don't do vesting schedules on our bonuses product. And that's where we're at with the current rates. So we like to share, when does a bonus make sense? So having that upfront immediate bonus is going to help in the way of perhaps wealth transfer. It means that that bonus is applied to the death benefit immediately. That bonus might be good for somebody maybe that's going to annuitize down the road. So they're going to get that nice increase again of that upfront bonus, and that's going to impact the annuitization payments. If they do elect to put an income rider on, they're seeing that 10% bonus there as well. So that's going to help from an income standpoint as well. It also impacts the 10% penalty free that they're going to have available starting in year 2, because they're immediately getting that bonus. It's good for recover from an underperforming product. Maybe they've lost some money, or they got a late start in putting away for retirement. And then it can be kind of a neat thing for perhaps a Roth conversion. And that's going to be my first sales idea. Before I do that, though, we did take a look at something. We were kind of curious. We wanted to compare a bonus product with a non-bonus. So we are using, for the bonus product, 10%, we're using a cap of 3%. And then for the non-bonus product, we're going to use a 5% cap. And we just wanted to see where that crossover point would be, because the bonus product is getting that boost right up front. And granted, it's got a lower crediting cap. We wanted to see at what point that non-bonus product would take over. So as you can see here in this example, it's around year 7. I think a lot of people would have thought it would be sooner, with a 5% cap. We've gone back for this example, we've gone back over the last 20 years, and then we've looked at the best 10-year options. That's how we're coming up with the growth part of it. So pretty interesting. Takes 7 years before the non-bonus product takes over. So then, in fairness, we wanted to look at a bad scenario for growth in the S&P. So we've done the same thing. We went back over the last 20 years, and then we found the worst 10-year period to go off of. And it's actually year 14 is when that non-bonus product finally catches up to the bonus product. Again, because it got such a boost with that 10%. So I mentioned the Roth conversion sales idea, and we're actually using 2 of these, the market power that I've hit home pretty hard on, and then our market value, which also has been around since 2004. So we have all that renewal rate history on the market value as well. So I wanted to show you where the rates are at with the market value, because that is one of our bigger accumulation products. So very strong rates. Again, I'm showing the non-income rider rates. So definitely built for growth. We said, let's not put a bonus on this, and let's really try to get the rates as high as we can. All right, so the sales idea. Looking at a Roth conversion opportunity. In this example, we've got $250,000 sitting in an IRA. Client sees the value of Roth. The downside is when you do a Roth conversion, you got to pay taxes. So what we're doing here is we're splitting that $250 up, just a little over $70,000 going into that accumulation product, the market value, and then a little over $179 going into that market power, the 10% bonus. So the client converts what was put into the market value, converts to the Roth IRA, which means they've got some taxes to pay. And we're using an example of 22% tax rate. So that's going to cost $15,570 in taxes. We wait 1 year on the market power, we throw it into the fixed bucket, and after 1 year, the client takes their 10% penalty-free amount out, which is going to include that 10% bonus. So they've got $19,961 to work with. Now, it might be appealing to just go out and buy a boat. And I know if Mark Trippett was on here, I think he would advocate for that, or maybe not. But they take that withdrawal, $19,961, and they're going to take $15,570 out of that, and that's going to cover those taxes on the Roth conversion. We've got $4,391 left, and that's going to cover the taxes on the withdrawal itself. We just look at, what the values would be at the end of the year with, assumptions. And so now the client is sitting there with, granted, most of it's still in the IRA, but some of it is now Roth at 253, almost 254. And, we've been able to basically do that conversion without any out-of-pocket cost to the client. Now, let's say they had some money sitting aside where they could contribute to some of the taxes. Well, then they could maybe convert even more than this example. So the other product that I wanted to talk about in the sales idea, I don't have really a lot of slides for this one, but this is our Market 10 bonus index. It's a 10-year chassis. It's approved in every state we do business in, except New York. And I do need to backtrack. The market value that I just covered is available in every state we do business in, except New York. The Market 10, I believe, came out in 2005. So another product with a lot of legs underneath it and a lot of history on renewal rates. So what's kind of unique about the Market 10 is that it's got two pretty neat features. And I think these are going to be very attractive to your typical bank CD client. So it does offer a 6% bonus. Again, no vesting schedule, an upfront 6% bonus. But we give that bonus for any premium the client adds in the first 5 years. If you think about your typical bank CD client, usually they own more than one bank CD and they don't all come due at once. Sometimes they've laddered them. So the client can open the Market 10 up with that first bank CD, and then as the other ones come due, they can slide them into that Market 10 and get a bonus on those. So for the first 5 years, 6% bonus is available, probably better than any 401k match you're going to find out there. But again, no vesting schedule on that bonus. The other thing that is very attractive with the Market 10 is it has a built-in return of premium. So it's built into the product, it's priced into the product. You're not going to see an external fee because it's priced in there, and it's available day one. So what that means to the client is at any time, if they need to fully surrender that annuity, at a minimum, they're going to get their money back. If the bonus and growth minus surrender charges, if that happens to be more than the premium, they'll get the better of the two. But the worst case scenario is they're going to get their money back. One of the biggest objections that people have with annuities, as we all know, are surrender charges. And there are some clients out there that, they've heard the word annuity and they've just, heard that, oh, I need to stay away from those. And, that's just bad. Anything with an annuity in the word is bad and I'm going to stay away from it. Unfortunately, there is that perception out there. And it was kind of neat. I had a very good advisor one time. He talked about how he overcomes an objection to an annuity. And I call it drop the rope. Like if you're in a tug of war with somebody on a rope, if I pull on that rope, they're going to pull harder. And when they pull harder, I'm going to pull harder. So what if you just drop the rope? And I use that analogy for what this advisor said he did when clients have objections to annuities. Client says, Mark, I've heard horrible things about annuities. And he said, instead of, oh, Mary, annuities are great. They're tax deferred. They provide lifetime income. They've got, all these great things. He said, I don't do that because all I'm doing is pulling on the rope. What he does is he drops the rope and he says, Mary, there's some annuities that I don't like either. Tell me, what is it about annuities that you don't like? And he gives her the opportunity to explain what it is, which could be a, misperception of, what she'd heard that was so bad about annuities. And it's usually going to be surrender charges. If I put my money in an annuity, I'll never get it back. If I die, they keep it, which of course we all know that's just a life payout on a SPIA. But I'll bet you Mary doesn't know about the return of premium on the market 10. So instead of pulling on the rope, he just says, there's some annuities I don't like either. Tell me, what is it about annuities that you don't like? And it helps get the issue out of the way. The other thing that I like about the market 10 is I always say that it plays well with other annuities. And what I mean by that is I've had several advisors that, let's just as an example, they're looking at placing $100,000 in FIA for a client. Well, rather than put it all into that FIA, maybe they carve out $30,000, put it into the market 10 with that built-in return of premium to kind of give that warm and fuzzy feeling about, okay, I can get to some of this if I'm in dire straits, if things are really crashing down on me. I've got that ease, comfort of knowing that I can get to some of that. And then let's take the other $70,000 and let's put it in something like that market value, and let's put that thing to work. Let's get that thing growing. So it's a product that plays well with other annuities, and it's a great FIA for somebody that maybe is used to bank CDs. I do want to show you the rates on the market 10. They are going to be the lower of the 4 FIAs that we offer, and part of that is because of that return of premium. That is a pricey thing, in the product. So earlier I had mentioned that we're known for our annuities. We do a lot of indexed, but we're not just an FIA provider. We've got a really competitive SPIA. We've got a very competitive traditional fixed product. We've always been in there in the MYGA game, but we're not just an FIA carrier. We do a lot of business on the fixed side as well. Some people, though, don't realize that we've got these 2 nifty little products, and they're both single premium life. The Wealth Max we've had around for a long, long time, and it really has been kind of a leader in the single premium life market. Now, the Wealth Horizon, it's got a few less, bells and whistles. It's got a higher base amounts, higher crediting options. the two products, they are life products, but they fit the annuity space so well. Single premium, so it's not like the client's sending in monthly checks. These can be a great alternative to annuity. If you've got a client that's going to put their money into an annuity and probably never touch it, this is something that I think we should at least look at. So the underwriting is what we call simplified. So single premium, we've got the health questions on the app. If they say no to all the health questions, and we're issuing standard through table 4 to kind of give you a gauge. We've got some great underwriting materials to help you kind of navigate with your client if they are going to get approved or not. So you fill out the paperwork. If it's all no's on the health questions, it's on average about a 20-minute telephone interview. And then you're going to get a decision right there on the call whether it's approved or not. So I want to kind of go over a case study with that Wealth Max. It does have a 5% premium bonus. Again, no vesting schedule. And it also has a built-in return of premium, just like that Market 10 that I covered. So a built-in return of premium, available day one, priced in the product, no external fee for that. And so I want to just kind of go over a case study. So we've got Carolyn. She's 60 years old. Let's say she's got, and I know Partners Advantage. In fact, I just saw a thing they put out on LinkedIn yesterday. They like to talk about dusty money or lazy money. So this is money that Carolyn doesn't need. Fell into her lap. She's covered in all these other areas, and she's got it sitting in a bank CD. We'll say it's earning 2% right now. So this is money, really that she does not need. So she's got 2 granddaughters, Emily and Katie. She loves the idea of being able to pass something on to them when she's gone. Maybe it can be used as a down payment on a home, to start up their own business, higher education. She just loves the idea of being able to pass something on. She wants to keep it safe. That's why it's sitting in the bank CD. She wants it to grow as much as it can, but she's not going to put it in the market. She wants to keep it safe and make sure it's there. She does have concerns. What if my health changes down the road? Nobody wants to be a burden to their family, but that is going to be in the back of her mind. So she's got, in my opinion, 3 options. She could leave that in the bank CD. It'll be nice and safe. It's not going to grow a ton, but it's safe. She could move this into an annuity, and we're going to assume a 3% growth. So we're being kind of conservative there, but that's a perfectly good sale. We see that sale all the time. Or let's take a look at her putting that into the Wealth Max bonus life. So we take that $100,000 and we can immediately turn that into $195,000 in the way of a death benefit, guaranteed to age 121. She hasn't even left your office with her policy, and we have immediately turned that, almost doubled it in this scenario, in the way of a death benefit. Before, she was looking at Emily and Katie each getting about $50,000 and some change with growth. Now she's almost doubled that for both. I mean, if she really doesn't need this money and she really does want to pass it on, we've helped her out in a big, big way with some very light underwriting. We like to use this graph. We do have a great client-approved presentation on single premium life. And it's probably the most popular marketing piece that we get asked for. And this graph is inside that piece. But we're just simply comparing the three options that we went over from a death benefit standpoint. As you recall, we were assuming a 2% growth on the CD and a 3% growth on the annuity. And even after 20 years, neither of them are nearly touching the wealth max of a death benefit. And by the way, this one plays well with other annuities too. I've seen people, they'll take 100,000, put 30 into the wealth max and take the rest, put it into the annuity. They've got a little extra death benefit through this, and then they've got, some growth opportunity with the annuity. So Carolyn's plan, her plan is to pass this money on to Emily and Katie. Her plan is for it to grow as much as it can, and her plan is to keep it safe. That's Carolyn's plan. Well, everyone has a plan till they get punched in the mouth. Words from the great philosopher, Mike Tyson. I think we've all seen that quote from Mike Tyson at one time or another. So what if something changes? I don't know if you recall when I started this case study, one of her concerns in the back of her mind, what if my health changes? Life happens, right? I mean, I'd be shocked if there isn't any advisor on this call that hasn't gotten a phone call from a client where something has changed and they need help. So inside, built into the product, is a living benefit rider. And what I love about this living benefit rider is it covers three elements. You've got the terminal illness. So if she becomes terminally ill, she's going to have access to 95% of that death benefit in a lump sum. That'll help her take care of any concerns or any money issues that she has going on because she's obviously got some health problems. It also has a nursing home confinement. So if she has to go into a nursing home, she's going to have access to 85% of the death benefit in a lump sum, or she can get all of it if she takes it over 36 months. The third element is the chronic illness. And that's not a confinement. That's 2 out of 6 ADLs. And if that happens, so she could be living at home, but she can't perform 2 out of 6 ADLs, then she's going to have access to 75% of the death benefit in a lump sum, or she can get all of it if she takes it over 60 months. I have more advisors selling off of this feature than the death benefit itself. These are big concerns for clients these days. This is not long-term care insurance. This is a living benefit rider inside of a life policy. But it is hard for people to qualify for long-term care insurance these days, and it's very expensive. This isn't going to replace something like that, but it could be a great supplement to when they run into these issues. What I like about this feature and the way we did it is I love that we've got all three elements in there, because a lot of them that I see out there, they might have the nursing home, but they don't have the chronic illness or vice versa. So I love that we've got all three. And then I love on the 2 that they've got an option. They can take a discounted lump sum. It's probably going to be taxable. Or they can get all of it if they take it over, spread out over the months, which shouldn't be taxable. Again, a great selling feature. We've got some neat things on our illustration that kind of highlights this feature. And there is a way to reverse engineer what you would need to put into the Wealth Max to get a certain, monthly payment out of either of these options. I did want to show you also where the rates are. So it is It's like a whole chassis design, because I had mentioned the death benefit's guaranteed to age 121, but it's got an IUL look to it because we've got crediting methods tied to the S&P 500 that everybody knows and recognizes, as well as that Barclays Focus 50, that's that 125% point-to-point par, and then that S&P Mark 5, which is at 140% point-to-point par. So I am going to wrap it up here. Just kind of the takeaways. I went over that market power bonus and the opportunities that are available. Maybe it's a Roth conversion. Maybe it's somebody that got a late start putting away for retirement. They got beat up in the market and they need to get caught up. The bonus can be a great feature when they're going to take income, maybe through annuitization or through an income rider. The return of premium on the annuity, that gives that peace of mind. It's that market 10, like I said, plays well with other annuities. You don't always have to put everything in one product. Sometimes it makes sense to spread it out, and you're creating more of a game plan than just selling a product. And we do have the return of premium on the life side with that Wealth Max. The renewal rate integrity and transparency, I do think that's very important. I think the market power has been around since 2004, the market 10 since 2005, the market value since 2004 as well. And then the single premium life. I think there's a great opportunity. I see more advisors that are, very strong annuity advisors. They're the ones that seem to really gravitate towards this type of a life product, because the underwriting is like I said, simplified. So I'm going to go ahead and wrap it up with that. Again, I want to thank Partners Advantage for having me on the call today, and I hope everyone has a wonderful weekend. Thank you.